And it does take more time to double something than it does for it to get cut in half, because markets tend to work their way up slowly, like you're walking up a flight of stairs, and then they waterfall crash down. And when they waterfall crash down, it destroys value very quickly. And the best thing to combat that is simply to put gold in your portfolio. Hey everyone, this is Rob Kientz with Gold Silver Pros reporting for JM Bullion. In today's video, I wanted to talk about a little bit about the economic cycle and how this one very important fact can save your portfolio. A lot of what happens to people when they get started investing is that they'll invest in one thing and just kind of stay in that thing, and they don't really pay attention to what's going on in the markets. And for example, let's say you're in the stock market for 10 years, usually you'll hit at least one crash in that time period, which will kind of wipe out your portfolio. And you kind of got to go back and rebuild it over time. And the thing to remember is if you have $100 in your investment account and you lose 50% of value, it goes down to $50. To get back up to the 100 that you originally had, it has to double. So not go up 50%, because 50% would only be to 75. To get to that original 100, you got to double. And it does take more time to double something than it does for it to get cut in half, because markets tend to work their way up slowly, like you're walking up a flight of stairs, and then they waterfall crash down. And when they waterfall crash down, it destroys value very quickly. And the best thing to combat that is simply to put gold in your portfolio. If you had a 10% allocation of gold, a lot of times it reduces a lot of that risk. And so that's something that I do in my own life is make sure that I've got that 10%, at least 10% exposure to gold, and even silver if you want to. So that when these market waves come, as they do every 4 to 10 years, throughout American history, this is normal. You have inflation, deflation cycles. As that happens, having gold in the portfolio can really stabilize it. So I'm going to give you a couple of really quick and easy charts to kind of explain how this situation works. And I think once you see it and start applying this information, it's going to make you so much more effective in saving more money and investing and growing your portfolio. The key thing to remember, if you listen to Warren Buffett, is the first thing you do when you invest is don't lose money. The second thing, you don't lose money. And the third thing is C1 and 2. And the way that Warren Buffett made his money over time was simply not losing money on investments, not making too many mistakes, and allowing himself to get those positive returns more consistently throughout his career. So we're going to talk about basically what we expect to see in the economy. Now, this is something put together by a friend of mine based on Bloomberg data, who does a lot of analysis on the economy over time and things like that, much like I do. And right here, he's documenting the last time we had big inflation, and that was in the 1970s. I don't know if all of you are old enough to remember. I was a baby at that time, born in 74. But I just remember having high inflation all the time, even when I was a kid, and my mom complaining about it, and parents complaining about it. Like, how do we afford things? How do we make ends meet? But what was interesting about the period, everybody remembers the inflation, but they don't necessarily remember the deflation. And deflation in these long inflation cycles tends to come after inflation, and they come in waves. So as you can see here, Tavi's pointed out this first wave of inflation that we went through, because this year, what did we have? We got up to something like 9.2% on our official government inflation called the CPI. That's pretty darn high when our central bank, who issues the money, and the government are really aiming for 2%. Okay, 2% over time is actually a lot of money, but 9.2% over time is a lot more. Now we have come down from that. The latest prints are somewhere like in the 7% range. So the inflation has come down. And so I think a lot of people are now feeling comfortable in the market, and they're jumping back into stocks and things. And I think the last calendar week, even despite the Fed's warnings over them likely having to tighten and restrict monetary flows, which will cause a deflationary cycle, despite the warnings of the Fed, people are jumping back in the stock market, and it got very euphoric at one point. And I think people are thinking, oh, we're done with the inflation. It's going to even out. We're going to get back to that 2%. But if you listen to what the Fed says, they've come out in the last week, 3 different, the Fed chairman Powell and 2 other Fed regional banks managers have basically said they want to peg their target for interest rates at 5%. So if they put their interest rate target at 5%, and it used to be 2%, basically what that means is they're expecting more persistent higher inflation over time. So in other words, they're looking at this chart. This is what the Fed sees. They know this because they were there in the 1970s. And it was the famous, Fed chairman Paul Volcker who raised the interest rate to almost 19% and got, the runaway inflation under control. And eventually it came back down. But that was really during the third wave of the inflation, the 1970-80 period. The nation had already been through these original two waves, and it's really kind of destructive to portfolios. Because think about it, if you're betting on an expanding or an inflationary economy, you're going to make the bet a certain way. And if it doesn't go that way and we hit, you hit this deflation period and you're not prepared and you have it pulled back on your inflationary investments, it could tend to really damage your portfolio. And remember, when you deflate your portfolio down, say 50%, to get back up, you have to go up 100%. And that's one of the reasons why these waves of inflation occur, because the market is trying to get back to where it was before. But the problem with that is the deflation says you can't. The underlying structure of the economy is not such that we can continue growing. We, at some point, have to clog out the system. It's kind of like you have to change your air conditioning filters, have to change your toothbrush every once in a while. Essentially, the economy is kind of the same way. It can get overtaxed, overused, and we need to do some things to kind of change, the approach. And that's what the central bank does. What I'm going to focus on is trying to help you to deal with what is coming by providing you, key timely information. So I'm going to dig a little bit into what happens with the Fed. The Fed will both raise interest rates, which is making money more expensive for the banking system and therefore for you and I and businesses and anybody who does banking. They'll also pull back the interest rates when there's a recession to try to pump more money in the economy and try to get that economy moving. They just try to put some aggregate, meaning at the top level of the economy, put money in, and then it flows down through the banking system and eventually out to people in the form of loans, cash, things like that. So that's kind of what happens. And I just wanted to show you the cyclicality of that. I'm not going to criticize the Fed here for what they're doing simply because this is something that has been occurring for about 100 years, honestly, is that raising, lowering the interest rates. And like it or not, we have a central bank and most of the world does. So while we could talk about we don't want one, we want to go back to gold and silver as money or a gold standard, I don't necessarily disagree with those things. But for purposes of this video, I really just want to educate on how the cycle works, okay? Because it's kind of here to stay, at least for the here and now. And so it helps us just to plan. And at the end of the day, the Fed is trying to do, the best that they can, and they're just trying to manage the economy. But they don't control the investment. The businesses and the people do. So ultimately, it's really up to the businesses and people to manage their own finances in light of this business cycle, which again occurs every 4 to 10 years. We have a recession on average. So here we can see the Fed rate cuts leading up to the housing crash. Those of you, if you're at least 13 or 14 years old, early 20s, a millennial, maybe one of the early Gen Zers, you probably remember that crash in 2008, the housing crash in Lehman and the mortgage market. And essentially it just threatened to kind of freeze up the banking system. There wasn't enough liquid cash sloshing around. There was a lot of bad debt, mortgage debt. The economy had been overheated. So what happened was the Fed basically had to cut rates. So we had the housing market crash. They cut the national lending rate from the central bank to all other banks from 4.75 to 2%. And that was kind of what helped a little bit soothe the economy, put some money back in the system. It's called easing. They put additional money in the system, and it did spur things. Now, the criticism is maybe it kicked the can down the road because we didn't get rid of the underlying debt problem that we had spent too much. But at the end of the day, the Fed doesn't control that. We do. They do control how easy it is to get money. So you could say if they're, when they're hiking rates, it tends to lead to recession. So if you look at 2015 to 2018, we hiked rates back. And then eventually we had a mid-cycle adjustment, 2019, a little bit of a pullback, not a full recession. Then we come up here and do taming inflation. This is what we're at now. The last, dating back to March 17th of last year, they began raising the rate 25 basis points, which is basically a quarter of 1% of an interest rate, to 50 to 75, and then to 50. So as you can see, this is like a bell curve, 25, 50, 75, now starting to slow down. So the Fed looks like they're slowing down the rate hike increases, which means businesses will probably stop around 5% somewhere. That's their goal. That's what Powell said, 5%. So they'll probably do at least one more cut to get it to 5, maybe two more, maybe a 0.75 or a 0.5, half point interest rates 3/4. And what it will do is they'll land at 5 and they're going to reevaluate and see what happens. Now, when this happens, they're reacting to what I'm going to show you next. So the stock market periodically crashes. And I just show you this chart of the major stock market indices in America to show you that we do have periodic crashes. The last big one was in 2008, 2009. That was as a result of the Lehman crisis, the mortgage market that I talked to you about just a moment ago. The other one was the pandemic. Now, this was engineered for a health issue, meaning the government started closing things down. It wasn't a recession caused by the economy per se. It was essentially the government said, we think we have a health crisis. We need to shut things down and get a hold of that. Well, the economy almost went vertically down when they did that. So that's different than a normal recession. Normal recession looks like that. It kind of water falls down. This is more engineered, like we're literally stopping things and it just goes. But in either case, whenever the economy overheats and needs to be pulled back for whatever reason, we have these 40+% stock market crashes. Of course, during the Great Depression, it was much worse when you have the bigger, longer term 80-year cycles, right? But I'm talking about the 4 to 10 year, what's in our immediate future type of cycle, just focusing on that time frame to really help us prepare for the recession that most analysts and most banks and even the Fed is saying is coming in 2023. Everybody sort of agrees we're in that recession mode. So we're going to expect a lot of the stock market to kind of fall off. And that's what it's puzzled me the last week is that the Fed's been raising interest rates to slow down the economy. That forces an accounting of the debt in the system and deflation as businesses have to service their debt. They have less money to spend on products. Consumers have less money because they're in debt now and credit cards and things like that. So we're going to have a recession. And what does that look like? Well, we're going to average the last couple of ones over 40%. Will we go beyond that into more of a Great Depression style? That is quite possible. It depends on a lot of things. It depends upon what the central bank does. It depends upon what the businesses do and what the people do. And it's really a complex topic that we'll get into maybe in a different video. But in any case, as we're going in recession, you can kind of expect this to happen. The reason it could be a little bigger this time, if you look in 2009 and 2020, we had these corrections. Not a big depression, but just like a recessionary correction. Enough to cause pain, certainly enough to not feel great. People lose their jobs, things get expensive, harder to come by. Things like it's not great, but it's not completely devastating. You can prepare. If you're in some gold and silver and good investments and you don't have a lot of debt on your personal balance sheet and your company doesn't have a lot of debt, you can survive recessions and pullbacks. Lots of companies do all the time. But look at where we are now. Before the last two recessions, which anytime you look at a chart from the Fed, from their Fed database, and the Fed is one of the most prolific producers of economic data because they watch it, it's their job. They shade areas of recession, and you can tell how long it is by how wide the bar is, and that tells you how long it lasts. So when we had this recession, we issued a bunch of debt between 2000, the tech crash, which is right here. So when the technology crash happened, a lot of those old technology companies went under. Things like new technology companies like Amazon were kind of born and developed. And we had a modest amount of debt increase. That was a quantitative easing type program where, we're able to, through easy money policy, allow people to borrow. Then we had the big crash, the mortgage crash, the Lehman one that I talked about, 2008, 2009, our last recession. People have dubbed that the Great Recession because all the stuff that went on was the biggest one basically since the Great Depression 80 years ago, and kind of a bigger one, right? So we increased, the central bank increased the debt whole bunches to try to spur that economy, right? And then you have a little baby recession. This is the pandemic, the engineered one, which didn't last long. It wasn't a normal business cycle recession. It was something they did for health reasons. But they also, because of that, had to spur that economy more. So you see the debt going near vertical. That's total public debt. So that's central bank debt. But what also occurred is everybody else incurred a bunch of debt. So I think that we've kind of, in a way, kicked that can down the road in dealing with the underlying structural issue. The debt issue has to be addressed. And so it's possible that the next recession we get into goes deeper than this one. And that is possible. It really depends on a lot of things. It depends on how we react, depends on how the government reacts, the Congress reacts. And it also depends upon whether this is just the US or now we're talking about the rest of the world. If it's the rest of the world, and all of a sudden we got to worry a little bit more. Because with all this globalization, we're all dependent on each other. Our biggest trading partner is China. Our second is the European Union. And in both cases, we spend a lot of money and they produce a lot of goods for us. Well, if everything slows down, that, between the nations, because we're all going through this economic cycle at the same time, then all of a sudden that affects everybody. So the stock crash could be deeper because there's really no safe place for people's money across the world in terms of most of the major markets. And so that can cause a little bit bigger of a crash. And remember, we're here. So I expect two more pretty decent recessionary trends before this is all cleaned out. And it could also take a number of years. So we could be in the 2030s before this particular situation has fully worked its way out, where we've dealt with the problems of inflation, deflation. We've worked out our debt. And just to let you know kind of how long sometimes it takes to work out debt. If you look at World War II and the amount of debt that we took on about the same amount of debt for World War II, for that conflict, as we have now as a percentage of gross domestic product. Now, obviously, the numbers are much larger now, but as a percentage of the nation's output, the amount of debt that we have now is almost the same. It's pretty close. And it took about 15, almost 20 years after the end of the war, with that post-war period boom where you had the 50s and the baby boomers living, extraordinary lifestyle that nobody had ever lived in America before. We had the emergence of the middle class, but it took about 10 to 15 years for the stock market to return, for real estate to return, for businesses to return. So when you go through these sort of longer, deeper recessions, they can take time. The good news for you, if you're interested in precious metals, is you can hold those long term, and they will help you weather that storm. Not only will they help you weather these 3 inflation deflation cycles that the analysts and the banks and the central banks have come out and said, we expect something like this to really kick off in 2023. It actually kicked off in 2022. But we do expect that deflation, then a big inflation cycle and deflation, that's going to occur. So precious metals really for the next 10 to 15 years, I think, is the best way to deal with it. And that's why I'm invested in it. And if you're interested, check below in the description. We have a little link there for you if you want to click on it and go to JM Bullion and look at their wonderful selection of products. If you click that link, you get a special offer of free shipping on $199 orders or more. So if you're interested in buying, maybe a couple $100 of silver, just getting into it and you're new, you get free shipping on that. You don't pay anything additional to get them to send it to your door, which is nice. I mean, you don't have to drive over there. They ship it for free. And if you're thinking about making a bigger order, that offer applies as well. And honestly, after having done this for about 12 years, I'm really glad 12 years ago I started getting into the precious metals, because I think honestly it's helped me weather a lot of this storm we saw through the pandemic. It's helped me weather business challenges. When I've run a business for a few years, and as you go through your growth stage of the business till you get to year 5, you're going to have your peaks and troughs. And it really was the precious metals I held in my company account that offered me that safety and security. And if I needed them, for the business, I had it. And then as soon as the business, picked back up in that cycle, I was fine. And so the precious metals has been my buffer, but personally and professionally. And without them, I shudder to think where I would have been if I had stayed deep in the stock markets and had a bunch of bonds. I would have lost a lot of value, honestly. And the great thing about gold, silver, even though they can be cyclical as well, they are your potential savior and your hedge in times of some sort of economic event or crisis, or where we're getting into this periodic inflationary, deflationary cycle. The last one we had was 40-some, almost 50 years ago. Time for another, we think. And I think the word coming out of the central bank, the commercial banks that do this research, most analysts, even the mainstream media like CNBC and Reuters and Bloomberg, Market Watch, they're all talking about this. So, it probably makes sense if you haven't thought about doing precious metals, now may be the time to jump in, and maybe a really opportune time. One last thing to remember, gold does well in both inflation and deflation typically. Now, it does have its cycles, but it does better in deflation. So ultimately, the economy is going to hit that third trough and it's going to come down in a big deflation. And that's going to be the last stage of working out all that bad debt that we just have, gumming up the works. And when we get there, you're really gonna, I think, want the gold and silver, because that's what's going to get you through, because during deflation it does best. And when you have big deflationary episodes, gold and silver shine more than anything else in the investment space. So it really becomes a great savings investment vehicle. So the title of this is "This One Important Thing Will Help You Save Your Portfolio." And what is that? That's basically precious metals ownership when you know that we're coming through another economic cycle, deflationary economic cycle. And I definitely think the next 10 years are going to be very interesting as we work through this, but we do have safety in the metals. And I think that is really what's going to help us out. All right, that's going to do it for today's video, guys. Feel free to continue following JM Bullion's channel. Run over to JM Bullion if you're interested in their product. They have wonderful products. If you guys follow me on the blog, just go to jmbullion.com/blog. I also have lots of great articles there that are great how-tos on getting into precious metals, how to view the market, along with a bunch of economic data to kind of help you understand where we are in this process. And once you understand where we are in this process, it really helps you to plan, adapt, survive, if you will. And I want you guys to do that. I want you guys to come out in the next couple of years as we go through this business cycle. We do it every 4 to 10 years. As we go through it, to come out ahead. And so that's why I made that recommendation. All right, it's going to wrap it up. Thank you so much, guys. Till next time, this is Rob Kientz, Gold Silver Pros.